Our stock of the day is Medibank Private. APRA telling it to set aside $250 million in extra capital after the insurer's data breach last year, where a hacker stole the personal information of around 10 million current and former customers, releasing it to the dark web. And the banking regulator now conducting a targeted technology review of Medibank, citing weaknesses it identified in its information security after the network intrusion. Medibank, in response, saying it will continue to provide its full support and work with APRA, but hold sufficient existing capital to meet the adjustments and won't be reducing its target health insurance required capital ratio. Yeah, in fact, I heard from the Chief Executive, David Koska, this morning saying it has strong and it is well capitalised at this point to meet those requirements. So, Mark, yeah, we know those issues. In fact, the stock sort of bounced back after that. Sort of Australians tend to take in these sort of intrusions in their stride now, unfortunately. But when you're looking at Medibank Private, what are you watching here?
I wouldn't watch anything. It's Medibank Private is a very, very ordinary business. If you look at their earnings growth, it's negative 2.7 per year average over the last 6 years. And I'm looking at the 10-year chart, and basically since 2016, I'll be kind and say it's flat, as in there's no growth at all. So it's dead flat. So there's no EPS growth rate. Now you can still make a return on a company with no growth if they run it well and you get a good dividend. The problem is it's on a 24 PE. So the market's paying a very high multiple for no growth. And you go, well, how does that equate to your returns? Well, it's not good. And we're showing it returning negative 0.1% a year. So let's say no growth, no return, zero.
Yeah.
So why would you buy it? Now, if you want to get a 10% return, which, by the way, 10% is not a really high return, particularly in an environment where we've got 6% inflation, you couldn't pay more than $2.90 for it. At the moment, it's currently $3.58. So it would have to go down, quite a ways to be able to even get a 10% return. So I have zero interest in it. It's a mediocre company.
All right. No.
And of course, there's $250 million they have to put aside.
Yeah.
If they're not going to change their capital ratio, how can that not hurt shareholders and dividends?
Right. Okay. All right. What about more broadly in the insurers? How you view them?
Well, we like NIB,
Yep.
NHF. They're much more entrepreneurial, and they operate in part outside the regulated environment. I mean, the problem with the health insurers is it's a completely regulated market, so It's very difficult to actually make good money, and they have these equalisation payments where, like NIB used to have to pay to Medibank a big slab every year because their profile of insured losses was lower than Medibank's. In other words, they had an older one, so they're going, hang on, that's not fair. Yeah. You're making more money, so give them some. And you go, well, great, what a great business to be in. It's about the opposite of being able to control your destiny.
All right, Luke, so Mark's certainly not interested. What about you?
I basically agree. I mean, it's a mediocre business, but it's defensive business. And I think that's the aspect that the market's really jumping on. We were just talking about a bit of a nervous market at the minute, particularly coming to year end. There's a lot of worries, over macroeconomics, the consumer. The one thing we know is that, health insurance like this, it will be steady. You'll get your government mandated 3 to 4% increase every year, and it'll tick along. I agree with Mark, though. I think the market's paying too high a price for that defensiveness. It's about 20 times earnings. I think it's a sort of business you'd like to probably buy about 15 times earnings. If you equate that to the dividend yields, about 4%, you'd probably like to see that get up towards 5 and a bit. If you look at the announcement today, it's a slap on the wrist from APRA. I mean, really, it's nothing. I think the negative reaction, it's off a few percent, is mostly because of this technology review. Medibank Private, no doubt, is a big bureaucratic beast of a business. Its technology processes, I'm sure, are subpar. And, the outcome of this review is probably some sort of transformation IT project that, we see the big four banks embark on every few years. So for me, look, I would hold it if you're someone who is just ultra defensive and just wants that as an aspect from your investments. Otherwise, I agree with Mark. Seek somewhere else if you're looking for any sort of capital growth out of your portfolio.
All right. Okay. That is our stock of the day.